Money doesn't wait for a press conference. It moves first, and it moves hardest when confidence starts slipping through the cracks. Currency volatility isn't just noise on a chart. It's the market repricing trust in real time. One day the dollar feels like a rock, the next day it trades like a risk asset, and when that happens, capital starts looking for something that doesn't require a promise to be believed. That's when gold stops behaving like a commodity and starts behaving like what it really is in the modern system, a global monetary asset with no one else's signature attached. On January 28, 2026, gold pushed to fresh record territory above $5,300 per ounce, while major reporting described the US dollar sliding to a multi-year low in the same window. Let that sink in. Record gold, weakening dollar, rising uncertainty, all at the same time. And here's why that combination matters now. A weaker dollar can lift gold mechanically, yes. But when the move is this aggressive, it's rarely just FX translation. It's usually a signal that safe haven flows are turning from optional into urgent, because safe haven flows aren't about optimism, they're about survival math. When portfolios sense that the ground is shifting, they don't ask, what's the best story? They ask, what reduces the chance of a catastrophic outcome? And that's how gold catches a bid that doesn't fade easily. This is not about believing gold is perfect. Gold can be volatile. Gold can correct violently. Gold can move sideways for long stretches. But when currencies start whipping and confidence gets repriced, gold doesn't need perfection. It needs conditions. And the conditions that historically drive gold's biggest, fastest repricings are showing up again. Here's what needs to be understood before anything else. Gold is priced globally in US dollars. And that single fact creates two powerful transmission channels. First channel, translation. If the dollar weakens, gold becomes cheaper in euros, yen, pounds, francs, and dozens of other currencies, even if the underlying real demand hasn't changed yet. That's a tailwind that can show up quickly, especially when international buyers sense momentum. Second channel, credibility. When the dollar weakens for reasons that look structural or political or fiscal, not just cyclical, it raises a bigger question. Not will gold go up tomorrow, but how much faith should be placed in paper value staying stable? That's the moment gold's role changes from investment to insurance, and insurance demand behaves differently. It can arrive suddenly, and it can stay longer than expected. Gold's price is often explained as a tug of war between real yields and risk. Real yields matter because gold doesn't pay interest. In theory, higher yields increase the opportunity cost of holding gold, but theory breaks down during stress because the trade stops being about yield and becomes about trust. Trust in policy direction. Trust in fiscal discipline. Trust that safe assets remain safe. Trust that liquidity will be there when it's needed. When that trust gets questioned, gold's lack of yield becomes less important than gold's lack of counterparty risk. A bond is a claim. A bank deposit is a claim. A money market fund is a claim. A currency is ultimately a claim on institutional credibility. Gold is an asset, not a promise. That difference is why safe haven flows can target gold even when interest rates are high. Even when economic data is mixed, even when the mainstream narrative says gold shouldn't be doing what it's doing, and when gold hits levels like $5,300, the story is not simply price up. The story is the market signaling that trust is being repriced at scale. Now, connect the dots with the flow mechanics. Gold is a multi-venue market. Wholesale pricing and settlement are deeply tied to London's ecosystem, often described through the LBMA framework. Futures price discovery is heavily influenced by exchanges like COMEX, where standardized contracts trade with leverage, hedging, and speculative positioning. Physical demand flows through refineries, bullion banks, dealers, and end buyers. And regional demand centers, including parts of Asia, can amplify tightness or premiums when buying accelerates. When safe haven demand rises, it doesn't come through one door. It comes through many doors at once. Some buyers grab physical, some buy ETFs backed by physical metal. Some buy futures, some buy options. Some shift reserve preferences, some hedge currency exposure by adding gold as collateral quality diversification. In a normal market, those channels balance each other. In a stress market, they can reinforce each other. Here's where it gets really interesting. The short-term supply response in gold is slow. Mine production doesn't double because the price rallied this week. Recycling increases eventually, but not overnight. Logistics, refining, delivery, and inventory mobility have limits. So when demand spikes rapidly, price becomes the balancing mechanism. And when price becomes the balancing mechanism during a confidence repricing event, the moves can become violent. That's why gold can jump not in neat, polite steps, but in lunges. That's why pullbacks can be sharp. That's why the market starts to feel emotional, even when the underlying driver is rational risk management. Now zoom out, because history doesn't repeat perfectly, but it does rhyme loudly in metals. In 1979 and 1980, gold's surge was inseparable from inflation anxiety and a crisis of confidence in monetary stability. That episode wasn't about chart patterns. It was about people realizing the currency's purchasing power could erode faster than expected. In 2008, gold's role as a hedge against systemic stress came into focus again, even as markets convulsed and counterparty risk suddenly mattered. In March 2020, something crucial happened. Even safe markets showed liquidity stress. There were moments when investors sold what they could to raise cash. Gold dipped at points, then regained its role quickly as the policy response expanded and longer-term purchasing power concerns re-entered the conversation. That pattern matters because gold can wobble during the first phase of a panic when cash is king for a moment, then strengthen during the second phase, when confidence becomes the real issue. So the central question is simple. Which phase is the market in now? If the market is in a short-term liquidity scramble phase, sharp pullbacks are a feature, not a bug. If the market is entering a longer confidence repricing phase, the safe haven bid can persist through pullbacks and corrections. That's the difference between a spike and a regime. Now bring the focus back to what's happening in the currency complex. Because the title is not Gold Rally. The title is Currency Volatility plus Safe Haven Flows. Currency volatility is a symptom. It tells a story about uncertainty. When the dollar drops aggressively, it can reflect many overlapping forces, shifting expectations around interest rates, fiscal risk, policy uncertainty, international capital preferences, and relative growth dynamics. But regardless of the cause, the effect is what matters for gold. A weaker dollar changes the global pricing dynamics of gold immediately. A volatile dollar changes the psychological demand for gold. And a dollar perceived as unstable changes the structural demand for gold. Those are three different layers. And when all three align, gold can move like it's being repriced, not traded. Let that sink in. Repriced. A repricing event is different from a trade. A trade is reversible when sentiment changes. A repricing event reflects a broader reassessment of value and risk. And gold above $5,300 is the kind of level that forces reassessment. Now, market mechanics, plainly explained. Gold trades in two main pricing references that most people hear about: spot and futures. Spot is the price for near immediate settlement, often used as a reference for physical transactions in OTC trading. Futures are standardized contracts traded on exchanges like COMEX. They allow hedging and speculation with margin. Margin means leverage. Leverage means volatility can accelerate because positions can be forced to unwind. That's why futures markets can amplify a move and also amplify a correction. And here's a key term to define: contango and backwardation. Contango is when futures prices are higher than spot, often because of storage, financing, and carrying costs. Backwardation is when near-term prices are higher than longer-dated futures, often interpreted as near-term tightness or urgent demand for immediate delivery. When metals markets show persistent backwardation tendencies, it can signal stress in the near-term supply-demand balance, though it's not a single variable proof. It's a clue, one clue, that something may be changing in the physical versus paper dynamic. Another term, basis. The basis is essentially the difference between spot and futures pricing adjusted for carry. Changes in the basis can reveal shifts in demand for immediate metal versus future delivery. These are the kinds of mechanics that matter when safe haven flows get intense, because flows don't just push price, they push structure. And structure is what tells whether a move has depth or just heat. Now layer in the demand fundamentals, because gold isn't only an investment asset. It has real-world demand categories. Jewelry demand is significant globally, especially in large consumer markets. Industrial and technology demand exists, but is smaller relative to jewelry and investment. Investment demand includes bars, coins, and ETFs. Central bank demand can be a powerful swing factor depending on the macro environment and reserve strategies. In stable times, jewelry can dominate the story. In unstable times, investment demand becomes the marginal driver. And the marginal driver sets price. That's why gold can rise rapidly even if jewelry demand softens, because jewelry demand is not always the marginal force during a confidence shock. Now, technical context, because price doesn't move in a vacuum, it moves through liquidity. When gold clears a major psychological zone, like $5,000, it changes behavior. Traders start looking at that level as a potential support pivot on pullbacks. Institutions start thinking in terms of rebalancing bands around a new anchor. Momentum strategies begin treating dips differently. At higher price levels, a normal pullback can be enormous in dollars. A 5% correction from $5,300 is about $265. A 10% correction is about $530. That can feel dramatic, even if it's routine inside a high volatility regime. So the right way to think about pullbacks is not, is the move over? but is the structure holding? If pullbacks are bought quickly and aggressively, that's a sign the safe haven bid is still active. If pullbacks cascade, liquidity dries up, and the market struggles to regain key levels, that can signal that the move was more speculative than structural. Now, stop, because here's where conventional wisdom gets it completely wrong. A lot of people assume that safe haven buying is purely emotional, that it's panic, that it's irrational. In reality, safe haven flows are often the most rational flows in the market, because they are driven by institutional mandates, risk models, stress tests, and correlations that break during volatility. When currency volatility rises, correlations shift. Diversification assumptions weaken. Portfolios that looked balanced suddenly aren't balanced. Gold often enters the picture not because it's exciting, but because it's one of the few assets that historically can behave differently when confidence wobbles. That's why gold's rally during currency stress can be a message about the rest of the system, not only about gold itself. Now, the bearish case must be faced honestly, because ignoring it is how people get hurt. First bearish factor, crowded positioning. And when gold moves vertically, traders pile in, funds chase momentum, options positioning can become lopsided. The trade starts feeling obvious, and when a trade feels obvious, it becomes fragile. Crowded trades unwind fast. If gold stalls near a key level and momentum fades, the same participants who chase the move can rush for the exit. That can create a downdraft that feels like a trap. Second bearish factor, profit-taking and rebalancing. Large funds often have rules. If an asset surges, it can exceed target weights, triggering selling even in a bull trend. That selling can happen into strength, then accelerate if the price starts to slide. Third bearish factor, policy and narrative shifts. If the dollar stabilizes sharply, or if policy messaging reduces uncertainty, or if risk sentiment turns back toward growth assets, safe haven demand can cool. Gold doesn't need fear to exist, but it often needs uncertainty to accelerate. Fourth bearish factor, liquidity events. In genuine panic moments, cash becomes king temporarily. Even gold can be sold to raise liquidity, especially if there are margin calls elsewhere. Gold can dip even when the bigger trend remains bullish. Fifth bearish factor, technical exhaustion. Momentum indicators can get stretched. Price can get far above key moving averages. The market can form a blow-off top pattern. None of these risks are theoretical. They happen in real markets. So the correct posture is not blind bullishness. It's risk-aware realism. Now, here's the piece that ties it together. Even if gold pulls back sharply, the question is whether the underlying drivers that produced safe haven flows have ended. Because a pullback can be a reset, or it can be a reversal. A reset happens when leveraged participants are flushed, momentum cools, and longer-term allocators step in. A reversal happens when the reason for the safe haven demand disappears, when the currency stabilizes, confidence returns, and the hedge is no longer demanded. So the key is not predicting the next $50 move. The key is monitoring whether currency volatility and confidence risk remain elevated. Now, zoom into how different participants might interpret this environment, because the same market can be a completely different experience depending on the time frame and instrument. For physical holders, gold is often viewed as long-term purchasing power protection, a hedge against currency and policy risk over years, not days. In that framework, volatility is expected. The main risk is not daily movement. It's overexposure relative to liquidity needs and time horizon. For traders, gold in a high volatility regime is a different animal. Futures and leveraged products can move violently. Stops can get swept. Spreads can widen. A move can reverse quickly. The key isn't being right, it's staying solvent through variance. For investors allocating in portfolios, gold becomes a correlation tool. The question becomes whether gold is providing diversification benefits relative to equities, bonds, and cash in a world where currency risk is rising. The goal is not perfect timing, but resilient structure. For newer participants, the core value is education, understanding spot versus futures, understanding what drives safe haven flows, understanding why gold can move with or against rates depending on the stress regime. Now, actionable intelligence to verify whether the gold go time thesis is strengthening or weakening. First, watch the dollar trend, not the headlines. If the dollar continues to weaken or remains volatile, the tailwind remains. If the dollar stabilizes and begins building a clear uptrend, gold can lose one of its strongest supports. Second, watch evidence of broad investment demand. Gold is not only moved by retail excitement. The most powerful sustained moves often reflect institutional flows. Tracking ETF holdings, reported investment demand trends, and broader market commentary around safe haven buying can reveal whether the bid is structural or fleeting. Third, watch real yields, but interpret them through regime. In a calm environment, rising real yields can pressure gold. In a stress environment, gold can ignore real yields if confidence risk dominates. The key is which force is stronger in the current moment. Fourth, watch technical structure around major psychological levels. Markets that break out and hold above big round numbers often indicate that participants have accepted a new regime. Markets that break out and then collapse back below those levels can signal a failed move. Fifth, watch volatility behavior. Orderly trends suggest persistent demand. Chaotic spikes and sudden collapses suggest speculative heat. Both can exist in a bull market, but the balance matters. Now, a verification call, because this must not be taken on faith. Check independent sources. Compare the timing of the dollar's weakness and gold's surge. Review reputable market reporting. Look at the World Gold Council's demand trend research to understand how investment flows behave in periods of uncertainty. Verify the data personally, not emotionally, because the edge is not believing a narrative. The edge is testing the narrative against facts. Now, bring it all together into a single thesis. Currency volatility increases the perceived risk of holding purchasing power in one unit of account. Safe haven flows are the system's response. Capital reallocating toward assets perceived to be neutral, liquid, and credible. Gold sits at the intersection of neutrality and liquidity, a monetary asset with global recognition and without direct counterparty dependence. When those forces align, gold can reprice quickly, and it can stay elevated longer than most expect, even through sharp corrections. That is not a promise. It's a description of how the machine behaves under stress. Now, 3 final takeaways to remember when the market starts moving fast. First, currency volatility is a signal, not a sideshow. When the dollar weakens sharply and gold is printing fresh records, it suggests that trust is being repriced and safe haven demand is active. Second, flow-driven markets are not gentle. They can surge and then snap back. Pullbacks are normal. Overconfidence is not. Third, the right approach depends on time frame and instrument. Long-term holders, traders, and diversified investors are playing different games even when watching the same price. Full risk disclosure, because it matters. Gold can be extremely volatile. Prices can fall sharply with little warning. Leverage can magnify losses dramatically. Market conditions can change quickly due to policy shifts, geopolitical developments, or liquidity events. Nothing here guarantees outcomes. This is educational information, not financial advice. Decisions should be based on independent research, risk tolerance, and appropriate position sizing. If the instruments being used are not fully understood, spot, ETFs, futures, options, education should come before exposure. And now, the closing thought. Gold doesn't need hype, it needs conditions. When currencies swing, confidence wobbles, and safe haven flows start searching for neutral ground. Gold doesn't have to be loved, it just has to be trusted, more than the alternatives. And in moments like this, that simple shift in trust can move markets farther than most people think is possible, and faster than most people are prepared for.